Pratik Gupta is with us, CEO and co-head at Kotak Institutional Equities. Pretty good to have you with us here. Thank you very much. I mean, if there is one space with significant tailwind, in terms of news flow tailwind, it's defense. Right? You had that recent conference, the Shangri-La Security Conference, which happened in Singapore, finished end of last month. And all the top guys were there, and the US Defense Secretary urging Asian countries to up their defense spending to about 5% of GDP. I mean, the average here in Asia is about 2% of GDP. So, yeah, I mean, everybody wants to spend more, be more self-reliant, etc., etc. The question, though, for investors is, and you'll keep getting on the tape all this news flow, which indicates more spending, etc. But you've got to weigh. You're buying stocks, right? You're not buying a story, and that's what one has to be careful about. What is your own perspective on this from an institutional angle? When you talk to clients, etc., large clients, is there interest in this space? To what degree, and what do they tell you?
Good morning, Prashant. I think, firstly, you're right that there is tremendous amount of tailwind for the defense sector as a whole. Obviously, and this is not just in India, this is happening across the board. Even Germany has announced $1 trillion plus worth of spending. Japan, Germany, a lot of Asian countries, and so on. And in case of India in particular, our defense spending has been somewhat below par, below what's required. And the recent conflict with Pakistan has perhaps woken up the establishment to the need for much greater defense spending. And this will be a multi-year theme. But as you rightly said, investors, especially the institutional investors, where at Kotak, when we speak to them, they are watching the space, but they are not, frankly, showing too much interest at these valuations. What's happened is these stocks have run up very sharply since Operation Sindoor on expectations of greater defense spending. We believe this has been driven more by retail and high net worth investors buying these stocks rather than institutions. A lot of institutions are staying away mainly because of, one, the valuations, of course, but also there are a lot of significant investments which have to be made by these companies across. And I'm not talking of just CapEx in terms of beefing up their capacity, but improving their technology, investing in R&D, in people, in doing JVs with global technology counterparts, in the ability to scale up, in qualifying for many of the government RFPs. For the working capital cycle for these defense companies tends to be quite long. Many of them don't have the required balance sheet. So there are some good businesses for sure, but as you rightly said, we are buying stocks. And at the moment, most institutional investors are sort of staying away because of the high valuations and the dramatic surge. They're eyeing the space. So as and when these stocks correct, you could see some disappointments in execution. Order inflows are there, but execution sort of falters. So that's when I think most of these institutional investors are looking to get back into these stocks.
Okay. Got that point, Pratik. Great to be speaking with you this morning. Thanks so much for being with us. I think the issue with the market also is the market is hungry for growth ideas, right? And they don't come by that easily anymore. And at least in defense, there's some news flow, at least on order book. And that's what gets people excited. But when it comes to, looking out for the next growth winners, do you see pockets? Do you see where maybe there's a turnaround in the works? Would it only be financials where at least now, like SBI told us, they expect to grow at least 13%. That's a huge bank. So where should one go chasing growth in this market?
So, Surabhi, that's a great point. Firstly, and as far as India is concerned, we think the macro environment obviously has been fantastic, but the problem has been earnings growth at the corporate level. On the macro front, obviously, the fiscal account, current account deficit, inflation, forex reserves, the government balance sheet, banks' balance sheets, corporate balance sheets, household balance sheets, all of that is in fantastic shape. The problem for the last 1 or 2 quarters has been that it's not translating into good corporate earnings growth. At Kotak, for example, for the Nifty, we are projecting only about a 12% earnings growth in FY26 and about a 14 to 15% earnings growth for FY27, which is better than what we saw, the low single-digit growth we saw in FY25, but still, frankly, not exciting given the valuations where we are at almost 22 times 1 year forward. Now, Having said that, I think one should watch out for policy action which could change this growth dynamic, given the strong macro backdrop we're in. For example, you already saw the very aggressive action from the RBI last week. Now, take a scenario where you also see perhaps closer to the Bihar elections, maybe petrol and diesel prices at the pump come off, especially given what's happening with global crude oil prices. So that could be another big positive. The GST rates could be rejigged, resulting in an effective lower GST rate, especially for the 12% and 18% categories. So you could see some benefit over there. Again, some money being put back into the hands of the common man. You could see the government capex cycle, which has been sort of lukewarm, execution issues as well. That could start picking up after the monsoons. And talking of the monsoons, while we're going through a bit of a lull period, but the forecasts are you'll have a decent monsoon, so you should see the crop output also picking up. So all of these factors coming together by the second half of this year should result in better earnings growth, we believe, and we may see, while in the short term for the June quarter and September quarter, we're actually worried about earnings downgrade risks, so that's a short-term concern. But as we go along into next year, we think you might actually start seeing earnings upgrades coming through as well. But you'll go down, then you'll go up. So you'll probably end up somewhere in the same, perhaps, hopefully better. But going back to your point on where we see pockets of growth, one is obviously financials, banks, insurance, NBFCs. We still like those stocks, especially given the valuations where they are. I would say some of the other pockets we like are, for example, telecom, hotels, the transportation sector, which is airlines, ports, the e-commerce logistics companies. Again, as the economy is recovering and again, keeping in mind the valuations where they are, we think these sectors are some which we like right now.
All right. Hi, Pratik. Good morning. Good to see you in. Pratik, you're talking about putting a higher amount of money in the common man's hands. Common man is also putting it into the mutual funds, and that's absorbing a lot of the selling that we're seeing. What are you making of these large trades? You know, the pace has accelerated. It's nowhere close to the euphoria that we saw in 2024, where you had much higher blocks. But actually, May was a month where, the last 1 month or so, we've seen rather high promoter selling, which has got absorbed by the mutual fund industry because they were sitting on ample liquidity. Is it getting to that stage where it makes you a little bit uncomfortable?
Not yet, Nigel. I think the amount we saw in May was, if I remember correctly, 60,000 crores, which is a large number, no doubt. But again, in the context of our $4 or $5 trillion market cap for the industry, and more importantly, the amount of cash that's sitting on the sidelines, both with the domestic mutual funds, the insurance funds, and also you have foreigners who are generally neutral to underweight on India. I think there's a lot of cash sitting on the sidelines. So that's why a lot of these block deals, IPOs, QIPs are getting absorbed quite easily. So I think we're still some time away before we start getting worried. Obviously, there's a large pipeline of IPOs and blocks still out there. As far as IPOs are concerned, Kotak itself is in the lead for many, many IPOs, but they're probably the large ones are more towards the latter half of the year. Blocks, again, that usually tends to be in between the earnings season when companies go into silent period. So another 1 or 2 weeks, 2 weeks or so, you'll have a lot of blocks happening. Then things will cool off as we get into the earnings season. But to answer your broader point, we think there's a plenty of cash in the domestic mutual funds. A lot of them are still getting net inflows. They're still positive. They were somewhat, underweight or sitting on relatively high cash levels. So that cash is now getting utilized. And the foreigners, as I said, that I think could be a big story towards the end of this year, early next year, calendar year, wherein the weaker dollar could result in more EM flows. And that in turn leads to India also getting its fair share. In fact, that's the one big trend one should watch for as we get towards the end of FY26.
Yeah. But we're in a situation where blocks are getting done. Maybe actually some of them at discount as well, but some of them not at discount. And look at Premier Energy. Stock's up 4% now, right? I mean, 2.5 crore share block got done, and it's moved up to about 1,107 or so at this point. Coforge is another one. Coforge is up 4%. The entire IT services back on one side and Coforge on the other. So exceptional commentary once again coming through from the Coforge management. IT services, and I don't know if you have any thoughts on Coforge specifically, Pratik?
So IT services, we've been somewhat cautious in general last few months. Our view has been that the US IT spending outlook is just, it's weak, but it's not deteriorating. The problem has been the valuations with these IT companies. Growth is for the large caps, it's in single digits. For the mid caps, it's in 15 to 20 odd percent, depending on which mid cap you're talking about. I won't be able to make any stock specific comments, but in general, the growth environment is stable, but the problem is valuations with risks to the downside, especially if the dollar weakens or the US enters a sharper slowdown than expected, or maybe even a recession. The ERD companies are the ones we are actually extremely negative on. They are the most vulnerable to a slowdown in discretionary spending. So the non-ERD companies we're okay with, but the ERD companies in general, we are quite negative. So, but in general, you'd stay away from businesses, companies which are more globally exposed. The big theme for us is India is still in a relatively sweet spot given our strong macro environment and okayish sort of corporate earnings growth. Globally, it's the US valuations, the US markets, they're looking expensive. All the institutional investors we speak to, they're extremely worried about a sharper slowdown, whether it's due to tariffs or due to the bond markets having a bit of a fit. Either way, but anything exposed to global demand, we would be a bit cautious on.
Okay, take that point. So have to tread with caution. And that's exactly what the market's doing, Pratik. By the way, the market slipped into negative after opening 90 points higher. So taking it easy, one step at a time. I think that's the investor mindset as well. Thank you very much for joining in.